I'm not a gambler and I'm not hoping that all of these ducks line up to do that. I'm betting on the Australian thing. And for me right now, I've gone, well, cool. Perth only gets a small amount of the population growth where Brisbane gets a much bigger line share. Brisbane's long-term performance has been stronger than Perth's. And that's how I went to the state of Queensland and then the city of Brisbane. G'day guys, welcome to the Pumped on Property show. Super excited for today's episode where we're going to be talking about the market and
how to select the right one.
I was just like, what's the title again? So it's how to select the right market.
How to select the right market, which is a tricky one for a lot of people as well, because most early investors, first timers, second timers, third timers have a real location bias. And they think that they should just be buying in their backyard, close to their home. But sometimes that doesn't make the most sense. Sometimes there's better opportunities out there. So in today's video, we're going to break down everything that you guys need to understand about buying in the right market at the right time.
I love that location bias thing, man, because everywhere I live, I think is the best place, no matter where it is. Every soccer team I support, every surfer I like. As humans, we just have this tendency to overvalue what we know.
Exactly.
And undervalue what we don't know.
Perfect example for me. My favorite city in America is Seattle, plain and simply because I'm a massive Seattle Seahawks fan.
Yeah. It's like you had an epic experience there. And to be honest, bro, if you hadn't have had that experience in Seattle and you had have had it in LA,
yeah,
you'd be is it a Rams fan?
Yeah, Rams, Chargers.
You know what I mean? It's just that moment that you have is what creates the bias, which creates the association long term. Because you weren't a Seattle fan before that.
No.
Tell people about this crazy night you had, man, because it has to be.
I love it. We're straight digressing, not into it. It was amazing. So I went over with Benny and a few other mates as well. But after Ben left, I went up to Vancouver and then down to Seattle with some friends, and Seattle Seahawks were playing the Carolina Panthers at home, and we're trying to get tickets, but they were super expensive. So we ended up just going to one of the bars to watch it. And when we were at the bar, it was so packed that we couldn't even find a table together. So I ended up sitting with these group of legends from Canada that were season pass holders, biggest Seattle Seahawks fan you'll ever see, paint on their face and everything. It was epic. They ended up having a free ticket and snagged onto it, luckily, and went and checked out the Seahawks. It was probably one of, if not the best nights of my life. I was just so into it. I'm such a massive sports fan. It was just such a cool experience to go there for free, to meet all the locals, to have that crazy experience. And yeah, completely. Now I'm just an absolute mad Seattle Seahawks fan.
I just love it, man. Tate, second best night was meeting you. Best night was Seattle Seahawks.
Oh, sorry, babe. You're going to listen to this.
They got married 3 weeks ago. It's no. So in terms of the very first thing with, the market side of things, it really comes down to the right market for you is based on the right strategy for you. So if you're a full-blown blue-chip investor which just wants CBD, Sydney, Melbourne, Brisbane, or walking distance to the beach in those markets, then that strategic decision is going to shape the way that you interpret the market and the way that you research it. If, like us, you're interested in capital growth, good quality timing, and buying as close to the bottom as you can in great areas, and also the capital growth, then that's going to influence the way that you look at things. If you don't understand markets at all, then most likely you're going to either get a hot tip from someone that doesn't know what they're talking about, you're going to get sucked in by something that looks really flashy, or you're just going to buy what you know, which is close to home. And regardless of, is it a good asset, bad asset, good time to buy, bad time, you're going to end up with something.
For sure. The last thing that you want to be doing is just going out there and buying a property for the sake of buying a property. So it always starts with strategy, figuring out what is this purchase, what is the intentions of this purchase over the period that I'm expecting to hold it? Am I looking for just a capital gain, or am I looking for cash flow? Do I want a combination of both? And then creating the plan from there. And there's a whole bunch of information that we'll go through right now to kind of make sure that you're focusing on the right area depending on that strategy.
Now, the biggest thing that I learned is that Australia isn't a market.
No, it's not one market.
The CBA has just come out this week and said they expect Australian property prices to go up by 9% this year, houses. There's going to be winners and losers. There's going to be some markets that go down 10% this year. There's going to be other suburbs that go up 30% this year. And there's going to be everything in between. And so it's very dangerous when you start to interpret the market in that way. So what Australia is a series of capital cities, some which work in a similar cycle, others that work completely out of cycle, as well as regional major markets that are like secondary cities, Wollongongs, Newcastles, Mornington Peninsulas, Geelongs,
Goldie, Sunny Coast. So the major regional hubs that, generally run at a similar time to their capital city counterparts. And then you've got other regional markets that are basically speculation from, mining developments or things like that.
There's a whole heap of little towns in Australia that have really good local economies, really good job prospects, and really good long-term indicators. But, the reason Simon and I are so big on the major capital cities and the major regional markets is just we came across a piece of information years ago from CoreLogic, and I think, what was the exact number?
It was a comparison of the 7 capital cities in Australia versus the 7 largest regional markets. So some of the regional markets in Australia are bigger than the capital cities as well. So it was the 7 largest regional markets compared over a 20-year period. And what was found is the metro markets outperformed the regional markets by 85% over the 20 years. So for us, we're long-term investors, and we think everybody should be long-term investors as well. If you're trying to get the best return on your investment, the numbers don't lie.
So finding that piece of information, I was like, cool, now I know what type of investor I am. My strategy is to get above average long-term capital gains. So it means I'm a metro investor, or at strategic times, I do like the Sunny Coast and Gold Coast, for example. So going from there then, there's no Australian market. There's just a series, in fact, tens of thousands of markets within Australia. And so to get through all of that complicatedness and to stop wasting your time online every single night looking at this thing and that thing like I used to, what we then do is we go down to a state level, because you cannot be a specialist and get a great outcome in property or stocks if you're just looking at everything. So I go Australia, and then I start to look at people like Heron Todd White, CoreLogic, SQM Research, CBA, Westpac, Phil Anderson, and I go, well, what are all of these different people saying? Now, there's a thing called timing, which we'll talk about in more detail towards the end of the podcast, but what's happened is Sydney and Melbourne since the GFC have gone absolutely nuts, and Brisbane and Perth have done absolutely nothing. In fact, Perth is 30% cheaper than it was 10 years ago, and Brisbane, there's literally suburbs that you can buy cheaper today with inflation than they were 10 years ago. So I go scratch Sydney and Melbourne because I'm not buying someone else's profit. There's no world that exists where I'm going to buy something for 60% more than I could have 10 years ago or 100% more.
The old days of property doubling in value every 10 years don't exist anymore. They're over. So the odds of Sydney and Melbourne having the same run that they've had over the last 10 years over the next 10 years it's not impossible, but it's unlikely.
The thing I'll say to that is just, it could happen. And I've looked at every single year for the last 60 years in Australia and overlaid Phil Anderson's cycle just for fun. I don't know, that's the sort of shit that I do at night. But it's like, I did that and I went, Sydney and Melbourne in the next 5 to 10 years we're moving into have had historically extremely strong growth in previous cycles. So what could get Sydney and Melbourne up in value is if we get massive amounts of immigration, and trust me,
it's coming.
Like what they did in the GFC to artificially prop up the economy was 900,000 people in 2 years.
Yeah, they were saying it could be 300,000 to 400,000 people per year once they do open the floodgates.
So that's coming to sort of save Australia again. If they let heaps of students in, apparently at one point there was 1 million Chinese students living in Australia as well. And then if they let the international money in as well as the super money and the institutional money. Now, Australia's just being driven at the moment by locals, but if you had that big institutional money, like there's about 800,000 people in Hong Kong right now that are really feeling sketchy about what's going on and want to move that money around the world's capital cities, and all of them are millionaires. And so it's like, if it's just Australians, Simon's 100% right. Sydney and Melbourne are probably cooked. They could go up, they could not. But if they let all of that institutional money in, then Sydney is so cheap compared to Monaco, LA, New York, London. Like, it is dirt cheap for the stability of the system that we live in. So it could well double in value in the next 10 years, but I'm not a gambler and I'm not hoping that all of these ducks line up to do that. I'm betting on the Australian thing. And for me right now, I've gone, well, cool. Perth only gets a small amount of the population growth where Brisbane gets a much bigger lion's share. Brisbane's long-term performance has been stronger than Perth's. And that's how I went to the state of Queensland and then the city of Brisbane. And
entry costs as well, right? You know, down in Sydney, to buy a quality asset, you're not getting any change.
That's the other one I forgot to say. Entry costs, of course.
$1 million, 900 grand in Melbourne, $1 million in Sydney for what we would be buying because we're quality investors. Where in Brisbane or Perth, you're spending anywhere from $400,000 to sort of $600,000 for the same type of asset. So entry costs are a lot lower. So, you know, it makes it a hell of a lot easier, especially when you factor in that timing. You know, hopefully buying into a market that is expected to perform quite well over the next decade, you know, makes a lot more sense if those entry costs are a little bit lower and the expected capital growth could be better.
Exactly. So again, it really comes down to your strategy, and, you know, people that buy and hold Sydney, Melbourne are going to do so well over the next 30 years. It's just, I have a different strategy. Like, I'm looking for the cash flow and buying at the bottom of the cycle plus the long-term growth. So I think we'll come back to these drivers in a sec, Simon, but I want to talk more to this part of the city. So
yes,
like Australia is a series of markets and states, a city is a series of markets within a city.
Yeah, it's actually amazing once you learn about it, because, you know, most people think the Australian property market is the Australian property market, but it's not. But then you even think about a city, that isn't even a market. There's markets within the city, because you've got apartments, you've got residential, you've got closer to the city, you've got further from the city. There's so many different things that are coming into play here. But for us, because capital growth is such a big part of our strategy, regardless, then there's certain aspects that you should be looking at to hopefully get a better result.
Now, if you're in Melbourne, there's two markets you really want to be in within the city, and that is the eastern side or the CBD.
Yeah.
You know, North Melbourne and West Melbourne are beautiful. Over the long term, they're going to be great investments for people. They're affordable, but there's 200 years worth of land out there. And so it's going to have an effect because of demand and supply. When they can constantly release more land, it means that prices are capped by what people are prepared to pay for it. And so in Sydney, the market is the northern beaches, the southern beaches, the eastern beaches, the city. Then you've got the inner north, east and southwest, and then you've just got west. And so within those, there's clearly been massive winners and losers in the last 20 years, and Brisbane is no different. You've got East Brisbane, north side and south side, as well as the city, which represent really good long-term quality. And then you've got deep south, far north and west that, you know, probably don't, but deep south.
I think one thing to take into consideration here is supply and demand. So when you think about those markets, you know, let's take into consideration Brisbane. So you've got the north, the city and the south, which represent value. But as you go further west, there is more land. So that's more land to be developed, which means more houses, which means more supply. Whereas if you go closer to the east, there's water there.
You can't
build onto the water. Well, they're not going to build onto the water
unless we turn into Saudi Arabia, and then we'll reclaim the land. Or Monaco.
You know, you stick to your fundamentals and you understand that, okay, well, it's unlikely that there's going to be as much supply entered into these areas. If there is more supply, then it's generally going to put more pressure and more value into your property as well, because the only increased supply that you get if you're going closer to the water is if you go up. So it's just understanding those fundamental drivers to make sure that you're getting to the right asset.
You go to North or West Melbourne or West Sydney or West Brisbane, and when you drive around a suburb, you can feel it. You can feel that there's no renovated places, and there's a small number of them. That's untrue. There's lots of renovated places, but there's a very small number of knocked down and rebuilt brand new places. And so, as Simon said, because there's available land, it can keep sprawling, where when you get to the eastern side of any of those cities, you're landlocked. The only way people can increase the value is up, higher density, or in many cases, knocking down, rebuilding, or massive renovations. And that is what creates value in the land based on that proximity. So I think it's really important to note that, like, when I invest, I don't just want to get Australia or the right city at the right time. I want to get the right place in the city, and I want to get the right suburb. And we'll talk about that in the next podcast, how to find the right suburb and then the right property within that suburb after that, in terms of how we do it as a business. But you don't just want to go, if you're thinking about Brisbane or Sydney or Perth this year, that's enough. The rising tide will lift the boat. You want to think about, okay, well, what happens when the water drains out long term? Where do people really want to live? How can I get an extra 2% per year on my 500K or $1 million so that in 30 years' time, I've set myself and my family up with a $300,000 better off position?
Yeah, you're spending the same amount of money. You're waiting the same amount of time. Why not try and just be slightly better with that money?
So let's talk about some of the drivers within the Australian market, regardless if it's Sydney, Adelaide, Darwin, that result in above average returns long term.
Number one is people. Population growth. The more people, the more demand. There's no doubt about it. It's as simple as that. So when you look at the Australian market, and we've looked at articles and data from the ABS, which basically looks at where the population in Australia has been going. So, you know, they say that about 75% of Australia's population growth has historically gone to Melbourne, to Sydney, and to Southeast Queensland. Now, that's a huge chunk of the population, with another 12% going over to Perth as well. So, you know, when you think about that, 87% of the population is going into just 4 markets in Australia.
That's really powerful, because the cool thing about the Australian government is they've created like a 2060 vision, and that's scary because it's 60 million people in Australia is the vision, but you see the lion's share being spread across those same cities. And so Simon and I aren't gamblers, we're just data dudes that use that to our advantage. You know, population is so important. Michael Matusik just put out a great article on this. I think 75,000 people a year are now moving into Southeast Queensland, over 1,000 people a week into Brisbane, which is growth in terms of population we haven't seen. Something sly and secret happened in Perth over the coronavirus that no one knew about, and that is the big companies couldn't fly people in. So they moved like 25,000 people out of Sydney, Melbourne, basically into Perth over that time, and no one really knew about it. But there's just been, the problem with Perth for years has been this massive oversupply of accommodation based on overbuilding in 2011.
They went from having a 6% vacancy rate a few years ago to having a vacancy rate below, 1% right now?
Which is a chronic undersupply. And so that's a good early indicator. We already knew that Perth was going to start looking good soon. But now there's people there, there's no accommodation there, there's no new housing coming on in the CBD centre.
It's high incomes.
The highest incomes in Australia by far, like there in Darwin, because of all the miners.
The mining. And that's a thing, you know, love Perth, it's got so much potential, but it is so reliant on the mining sector.
It's still heavily reliant, and hopefully after this next cycle, give Perth another 1 million people, and like Brisbane, it will diversify into tourism, education, healthcare, hopefully professional services too.
No doubt about it.
But yeah, it is what it is at the moment. But another one that we look at is jobs. Now, we don't necessarily need to see job growth, but we need to see a high concentration of high-paying jobs in a city. And so, you know, same thing, like the Perths, the Brisbanes, the Sydneys and the Melbournes is where the jobs are just not just being created, but where the higher income earners congregate.
And you want diversity as well between private sector and public sector. You know, all of these different industries to kind of give a little bit of a range of different occupations that these people are working in as well.
Infrastructure is another huge one. There's two things to look at, and this is so easy to find online. One is the Australian government, state governments are constantly bragging, like I've said before, about how much debt they put us in. And so you can find every major project that's anticipated for Australia 3 to 5 years in advance. The second thing you can do is there was the coronavirus or COVID-19 infrastructure bailout program, which is
literally what they're calling it. They're calling it the coronavirus bailout program, and it's solely infrastructure.
Now, what would normally happen at this stage of the cycle, according to Phil Anderson and Fred Harrison, would be lavish government spending on infrastructure, construction booming, and then money becoming easier and cheaper. All of these things are happening as we speak. In Commonwealth Bank's words in the report this week to their private investors with very strong portfolios and internal high-level staff, they're basically saying that the infrastructure rolling out at the moment is nothing short of a boom, and it's going to create down the line boom conditions like we haven't seen for a long time in Australia,
if ever.
You know, like the Catherine Cashmore, who writes for Port Phillip Publishing this week, was saying the last time the market looked like this was back in the 1890s or the 1920s. Like, they're expecting things to occur because of the amount of money being created globally in cryptocurrency that just has been created out of air.
Yeah.
Plus the trillions of dollars that the banks have just printed globally, and the central banks still are. And all of that money has to come back into the economy through services, through property, through stocks. And so knowing this stuff now, before 5 years down the line when that money's circulated through, like we're talking about trillions of dollars basically. Like, it's just in unprecedented amounts of money that have been created in 1 year out of thin air that have to arrive in something.
Yeah, a simple way to look at it is one person's savings is another person's income. So that's a simple way to look at economics, because once money is created, it's got to go somewhere, and it generally trickles down through the economy, and it generally over the long term ends up back in the land values, because what most people do when they've got surplus income is they upgrade their home, whether it's through moving into a nicer home or whether it's renovating their current one, which adds value to it.
Now, I've talked to at least 10 previous clients this year and in the last month of December last year, and not a single one of them is earning less than $200,000 a year combined. And they're all just moving to Queensland at the moment, and they're selling assets down there that they've held for 10 years. They can trade their $1.5 million property for an $800K property up here that's the same, and they've got $700K sitting in the bank, which they can do whatever they want to do with. And most of them are thinking about putting it into other assets because they know that the government's got a $100 billion bond buying program between now and April, and then CommBank suggesting they buy another $100 billion of bonds between the end of the year after that. And it's like, just knowing these things in advance gives you a way to navigate through the really noisy media and go, what are the data points? What does CBA have to lose to say that, you know, we're looking at 9% growth this year? Like, what happens to their brand if they're wrong? And so, interesting.
Yeah, super interesting. Some of the other drivers that we talk about is demographics within a suburb, within a market as well. So generally those higher quality demographics, they're going to have more cash to spend. They're generally going to be earning higher incomes as well. So you can use that as a tool to kind of target capital growth as well. Obviously, demographics coming to people that actually own their homes versus people that are renting within the area as well. That can be something that you look at, because there's more people that own their home, then it's going to give that suburb, you know, a better, what word am I looking for? A better feel, or
yeah, it's just a higher concentration of owner occupiers. And I take care of my house. I do the lawn, I renovate, and therefore I'm spending money on my home each year, which is adding value to the suburb as a whole.
Yeah, exactly.
I like the fact that you sort of talked about that, because something that not heaps of people understand is just the power of demographics. Like, when we're looking at an area, we're looking at the average income, the higher the better. We're looking at renters in an ideal world below 30%, even 20%, but there's a lot of suburbs across Australia where they're close to the city and the beach and it's still above 40%. And that's just because speculators like me, look for those suburbs closer to the areas with the potential for growth and good renters as well. What I love about the ABS's data in particular is the government's spending millions of dollars a year forecasting population. One, so they can adequately provide services like healthcare and infrastructure and education, but two, just because they're collating the data. And so you can get a really good forward perspective. And that's why I'm such a big Sydney, Melbourne, Brisbane fan. It's the only 3 cities in Australia that are on the International Monetary Fund's top 200 global cities to watch out for in the next 50 years. It's the only cities that anyone moving from anywhere in the world understands. It's where the incomes are. It's where the best schools are. It's where the best infrastructure is. It's where the highest paying businesses and jobs reside. And because of that, and because it's landlocked on one side by an ocean, means that, those locations, particularly on the beach in those cities or close to the CBD centre, have unusually high potential chances of growth and cash flow long term.
Yeah, so when we're looking at the right markets, these are the biggest ticket items for us. So it makes it really simple right now for us to understand that Sydney and Melbourne look capped out, in our opinion. Obviously not long term, but over the next few years, in comparison to a place like Brisbane or Perth. And then when you look at these two markets for us, with Brisbane having the higher population, having the stronger historic growth, having the Gold Coast and the Sunshine Coast to the south and the north, ticks a hell of a lot of boxes for us.
Without a doubt. And, when we're saying this stuff, we've got no idea. Like, Westpac has come out and said that they expect Brisbane and Perth to do 20% in the next 2 years and Sydney and Melbourne to do 10 to 14. So when Simon's coming from that place, it's like it's data backed. It's not just we think it's going to do this.
Yeah.
Historically, based on Phil Anderson and Fred Harrison's timing of cycles, the secondary cities perform much better. Now, that could be the secondary cities of Europe. It could be the secondary cities of America or Australia, but that historically is what's happened. And it's so natural. People have got to a point in Sydney and Melbourne now, they've forgotten about it in the last year, but they're remembering it, that I don't want to live in an okay home 30 k's from the city for $1 million or spend $700 a week to rent a shithole there. I want a lifestyle. I want to be close to services, bars, restaurants, cafes, shopping centres, great schools, the ocean. And maybe I can have that in one of the regional markets around Australia. Maybe I can even have that in Brisbane. And knowing the average household incomes there are only 66% behind Sydney, they're actually higher per household than Melbourne. A lot of people are going, I'm over this grind and living this way. I'm going for a more affordable option. And once every about 10 to 15 years, we get this mass migration out of Sydney, Melbourne, LA's, New York's, London's into the secondary cities. And that is, as Simon said, the number one early indicator of what's coming next. And then you overlay dirt cheap money globally,
dirt cheap properties in Brisbane and Perth,
sentiment being at a 7 to 10 year high, according to Westpac. You overlay the fact that the government's spending massive money on infrastructure, buying huge amounts of long-term bonds back. The cash rate has been fixed. There's also a bailout in place for the banks. For people that need holidays, they can still get them if they're in risk of default. Savings have gone up by $125 billion on top of our extra normal savings in Australia in the last, 9 months alone. Like, just so many positive leading indicators. We're getting the highest percentage of new loans being written in so long, particularly in Brisbane and Perth. And if you overlay SQM's long-term data around the number of new loans versus what happens with capital growth after, they strongly correlate. When you look at the vacancy rates in your Adelaide, your Brisbane's and your Perth, they're all below 1%, which is a really good indicator to look at and watch for in terms of rental increases and long-term capital growth increases. There's some information from CBA where they reckon that for every 1% the interest rates drop and hold for a prolonged period of time, we will see a corresponding 15% gain in capital over that market's value. Now, if you think about that, interest rates have come down at 7% to 3%, and Brisbane prices are cheaper than they were 10 years ago. If CBA's long-term data on that is right, that could result in a huge catch-up. If you look at the price differential, I'm geeking out, I'm just going for it.
Yeah, go for it. I'm loving it.
If you look at the long-term difference between Sydney and Brisbane prices over 100 years, the value gap, Sydney's historically been an average of 55% higher now than Brisbane. Now Sydney's sitting at 95% higher than Brisbane. It's just so many things when you start to geek out like we do on this, that you can start to make better decisions around which market and why. And then how confident does that make you to go, here's 30 reasons why here. And then when this why isn't working anymore, then go find another why that's working in your portfolio.
It's absolutely fascinating when you break down all of these different things that we've researched and learned over the last few years. And, this is why we come back to, don't just go buy a property for the sake of buying a property. Do your research, figure this sort of stuff out, because it's going to have a down the line impact on your personal situation, your journey to financial freedom, the psychology of being an investor. And as we said, I'm spending the money. I want to make the most that I possibly can from it as well, or at least make the most educated decision with the information that I have right now.
You're trading your life, if you're single or with a partner, for this decision. And if you've got kids, you're trading your time away from your kids every moment that you have to work that you're not financially free. So when Simon and I talk about spending $1 million and you put it into a long-term capital growth calculator, the difference between a 4% return for 15 years on that $1 million and a 6% return compounded is 500 grand. When someone says to me that buying a property is enough, I'm like, you selfish prick. You're trading 40 hours a week away from your child, and you won't spend 20 minutes getting the right education to make a 2% better decision that's going to make that child $500K in the next 15 years better off. I'm like, I just want to shake people, because it's so easy. And if it's not easy, then, take a chill pill, step back and enjoy the process and figure it out yourself, or partner with someone like me or Simon that has been doing this non-stop obsessively for a period of time, and because of that has a way that we do it more effectively, so that you can spend and invest 15 minutes of your time a week, and we can do 50 hours of our time a week and, do all the running around behind the scenes, listening to me geeking out on this shit all day in the office. I feel like an arsehole. I feel like I just went on such a spiel. I don't mean to be aggressive or hard.
I
want the best for people.
Yeah, and we're practicing what we preach here as well. The strategies that we're implementing right now is based on all of the information that Ben's just broken down for you. You might want to rewind and go through that, because there is some absolute gold nuggets in there. I'm not going to lie, some of the best information that you could ever get. For us, understanding that we're focused on Southeast Queensland property markets, predominantly focusing down in Brisbane or up here on the Sunshine Coast, because we like the lifestyle aspects that the Sunshine Coast is providing. We like the affordability of the Sunshine Coast. We like how many eyes are up here right now as well, plus all of the infrastructure that's going in up here, plus the population that's moving to the area, ticks a lot of our boxes. Same goes for Brisbane. We're looking down in those markets, and then when we're looking at these markets, we're not going just buying a house and land package out in southwest or northwest Brisbane, just hoping for the best. We're going, okay, well, where are these higher quality demographics? Where are these locations that have already taken off? And maybe there's an area just nearby. For example, there's some suburbs in Brisbane where you can purchase properties in these areas for $600,000, $650,000, where the suburb that's 2-3 kilometers away, there's properties that are, $850,000, $900,000 for the exact same thing. So, understanding the little ins and outs of the market to try and get into these areas to maximize the potential from that ripple effect is exactly what we're sort of doing for ourselves, buying closer to those lifestyle areas like the beaches, buying slightly on the outskirts of town, knowing what the impact of COVID has had on where people are choosing to live now. and, you know, trying to make those educated decisions.
I love it, man. Like, I'm so excited about this stuff, and I'm so excited that you guys are getting the information. We're so grateful to have you part of our community, and we hope that you guys can whack this on wherever you are and enjoy it and learn from it, and, you know, take our ideas with other people's in your own research and just smash it and get financially free so that you can have the quality choices in your life that you deserve and that you should have in the future. You know, time with family, dropping your kids to school if that's what you want to do.
Finding a new hobby.
Yeah, extra days off, starting that business, or walking away from that job and not being scared to like re-educate yourself and follow your passion and follow your bliss in this lifetime, because it is short. But if you think about this stuff like we do and get a plan in place and slowly and consistently execute it, you'd just be shocked at where you could be in 10 years' time with the right types of assets bought at the right times with the right strategy for your situation.
It's so funny. Like, we were looking at that, the update from CBA, where they were talking about the 9% growth for properties over 2021. And, you know, I looked at my portfolio and I got one of the compound growth calculators up, and I put the total value of my portfolio plus an 8% return over the next year. And I'm like, it spits out over $100,000. I'm like, that's $100,000 that I didn't have to work for this year because I've made these decisions, because I bought these ones. And, you know, that's, as we said, 8-9% for houses on average. Obviously, there's going to be winners and losers. Hopefully, I'm on the side where I've got a couple of winners in there, so it might even increase that further. So, you know, if you're out there, you're earning $100K per year right now, it's a second income for you.
Completely. And, you know, that's the beautiful thing about people that invest in assets long term. Like, it's a bit scary at the start. You know, we don't always have all the information. We don't always have the right team. We don't always know who's who in the zoo. We don't always know what to buy, where to buy it. We don't know if it's the right time. But history shows that people that invest in high quality real estate or high quality companies through the stock market and hold them long term and consistently work towards their financial goals, get to lead the extraordinary lives filled with choices. And I think that's where we're coming from. We wish you, honestly, all the best this year. And as always, stay safe. Things can change with the blowing of the wind, but long term, you know, Australia looks really, really interesting to me personally, and I'm super excited about it.
Yeah, thank you so much for listening in, guys. Please give us a thumbs up, leave us a comment, let us know what your thoughts are. Share this podcast or video with somebody that needs to be needs to listen to it right now. Maybe they're looking in a market that they maybe shouldn't be. So, you know, share the video, get the knowledge out there. We're all in this together, guys.
Oh, sweaty, so sweaty.